Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the 3 monster growth stocks to buy in 2023 that could set you up for the rest of your life. For more videos just like this one, go and smash that like button right now. It helps me out a ton. Comment your favorite stock to buy right now down below because maybe I'll do a video on it. Subscribe if you haven't already, and without further ado, let's get right into it. Of course, we're going to start off with one of my favorite companies, but before we get into it, let's talk about what these companies will consist of. So when we look for companies that are going to set us up very nicely over the long term, we want a company that operates in an industry that is going to have a high level of demand for the foreseeable future. On top of that, we also want to make sure that this company delivers very strong financial results as well as overall revenue and earnings growth so it can ensure a steady share price increase over time. Lastly, we want to make sure that this is a sturdy stock that's somewhat resilient and it has a very proven track record, so we're not going to lose any money when we invest into these companies because we want to make sure that these companies will be around until we retire. So with that being said, let's jump into our first company, which is none other than Alphabet, ticker symbol GOOGL. And if you're not familiar with this company, don't worry, I'll go into detail, but right now, just think that this is a technology company and an internet company. The current share price for Alphabet is $96, while professionals believe this company is undervalued because they believe it should be trading at minimum close to $115 and at maximum close to $160. And because the current share price is trading below both of those price targets and price predictions, clearly we should be buying the company right now. You can even see that on the share price chart, the company has cooled off as of late, but that just gives long-term investors a great buying opportunity. This is literally a trillion-dollar company. It's worth $1.2939 trillion, and there is still plenty of upside left in this company. Alphabet is one of the best companies to buy on the stock market right now. I talk about it a lot and I'm still buying this company because they have amazing segments. They own and are the parent company to Google, YouTube, Waymo, as well as Google Cloud. And in this video, we're going to focus more on their cloud segment because if they can leverage their cloud segment correctly, they have a load of growth that they can grow into well into the future. For instance, the demand is set to surge for cloud-based services. This is an industry, according to Grandview Research, that could exceed $1.5 trillion worth of value in as little time as from now until 2030. This means that Google Cloud could be one of their best revenue and cash flow businesses that they have in their portfolio. I also want to mention that right now, the revenues that Google Cloud is bringing in for the company is around $6.8 billion for the third quarter. So that is a lot of money on a quarterly basis, but this also means that there is plenty of market upside and plenty of extra market to capture because the three main businesses involved in this space are going to be Amazon, Microsoft, as well as Alphabet. And I think that Google Cloud could capture a large portion of this overall market. On top of that, the other Alphabet business that is extremely innovative that brings in a load of revenues is YouTube. And YouTube is the world's leading video streaming platform, and that's probably what you're watching this video on. And younger generations absolutely just flock to YouTube because it's such a great platform. Now, if you're older and watching YouTube, don't worry because YouTube has a lot of educational videos which are extremely useful for learning. That's where I like to learn a lot of my skills by just looking up YouTube videos of how to do things. However, the great appeal to both younger and older generations means that the demographic of this overall streaming platform is extremely diversified, and we also see that there's a high demand for new videos every single day. On top of that, advertisers absolutely love YouTube, and YouTube loves advertisers because that's where they make the majority of their money. And we also believe that as the younger generation grows up with the generation of YouTube, particularly YouTube as it is right now, it's going to cause a surge of demand which could supercharge YouTube's overall financial growth, which in turn will help Google accrue money and of course the parent company Alphabet, because ultimately that's where it goes. All in all, Alphabet has delivered $282 billion worth of revenue and an EPS, which is their earnings per share, of $5.03 over the last 4 quarters. And this is absolutely amazing. This is an extraordinarily strong company that is set for long-term growth in the future. And that's why it makes up a large portion of my portfolio, because I have ETFs that are exposed to Alphabet, Amazon, and Microsoft, because these companies are so innovative and I really like the cloud environment in the cloud market that I want a huge piece of. On top of that, the recent share price has actually fallen to one of its cheapest valuations to date, which is absolutely amazing, and that gives us an opportunity to buy these shares as investors, especially if we want to hold this company over the next decade. The author summarizes Alphabet very well by saying that this tech giant isn't simply part of the future, it is set to shape it. So there is no question that Alphabet will be around in the future, and they're not just going to be there, but they are going to be shaping the future, because that's how instrumental this company is going to be for the future of not only the stock market, but just society as a whole. The next company we're going to talk about is a company that I think is somewhat overvalued right now, but I still like to nibble at it once in a while, because I think this is going to be a good long-term buying opportunity, and that is none other than Snowflake, ticker symbol SNOW. Currently, it trades for $152 per share, while experts believe the company should be worth anywhere between the range of $105 and $500. So these price targets and price predictions absolutely are wild, ranging anywhere between 105 to 500. That's almost a 5 times increase just between their high and low share price targets. However, regardless about who is right or which expert or professional is right in this scenario, this is a strong company. And I'm glad to see that the company is cooling off in their overall share price, because that just gives us a better entry point to buy this company for the long term. Now, I personally think this company will start to cool off again, but I also want to continuously nibble at this company because they are primed for future growth. As more businesses generate more data, there's going to be all sorts of companies that will need to specialize in a way to sort or organize or analyze this data. So the data not only needs to be stored, but it also needs to be analyzed. And Snowflake is one of the best companies to do just that. On top of that, this overall space of data storage and data analytics is absolutely huge, and it's rapidly developing. So Snowflake is clearly going to be a future long-term winner. On top of that, the management of Snowflake estimates that by 2026, the data warehouse and storage industry, just between those two, will be worth around $173 billion. And right now, Snowflake has a market cap of around $48 billion, so clearly they have a lot of market to be able to capture. Now, hopefully the market cap and the share price fall even further, because right now the share price is trading at a relatively high valuation, but if the share price probably falls to around, I don't know, sub $100, I'm going to be buying this company hand over fist. Snowflake essentially enables customers and consumers to bring various dispersed data together and for it to be analyzed at the same time. Revenue for the company actually soared around 67% year over year, which is absolutely staggering. Because if you've heard me talk about, if you can identify a company that is going to grow over the next 5 years at over a 30% CAGR, which is their compounding annual growth rate, you know that this company is absolutely primed for future growth. On top of that, we know that their overall market segment is set to grow as well, so hopefully this company can grow with their overall space. Customers are rapidly accepting the various products and services that Snowflake offers, and they also have a very good net retention rating of their customers. So any customer that Snowflake attracts and actually brings in, these customers tend to stay with Snowflake over the long term, and that is very, very good to hear from an investor standpoint, because I want a company that can maintain their current customer base without other companies stealing from them. This also means that Snowflake is very user-friendly, and I also like to see that in the various companies that I buy. Over the past year, the company's free cash flow has risen by around 622% to $65 million. That is absolutely crazy. Now, I would say the biggest concern for this company has been its valuation. Investors got really excited. The share price absolutely surged in the beginning. This company is also backed by Warren Buffett. However, However, this company is still trading rather high. That means their overall share price can probably cool off or come down in their share price before it becomes an absolutely amazing buying opportunity. The reason why I'm saying that is because it's trading at a high valuation of around 23 times their current sales. For a growth company, that's not necessarily too bad, but I would like to see this company probably around a 10 times PS ratio. Now, if we don't get that, that's okay. I'm just looking for the share price to drop below $100 per share, and then I would be happy buying this overall company. But for the future, man, even if you bought the company now and you're willing to wait over the next decade or two, this is supposed to be absolutely amazing over the long term. But you have to be willing to hold it for the long term, and you also have to have the stomach to hold it through volatility, because let's say the share price crashes from right now $150 down to just $50. Don't sell the company, because as time goes on, they're going to ramp back up, at least according to current projections. So even though this company is trading at a relatively high multiple, I still think this is a very good publicly traded company that investors should look into buying, or at least adding to a watch list over the long haul. Next up, we have another powerhouse of a company, and I've talked about this company multiple times because I love it so much and I currently own it, and that is going to be Mercado Libre, ticker symbol MELI, ticker name MELI. Now, if you're looking at the current share price of $873.54, do not fret, my dear friend. There are brokerage accounts where you can invest into fractional shares or share slices, so make sure you have a brokerage that allows you to do that. I know Robinhood does that. I think M1 Finance has like share slices or something like that. And I also know that Fidelity does fractional shares. So if you have any of those brokerage accounts, then you are set to invest fractionally into this company. That means although one share is worth $873.54, you could invest into this company for as little as $1. But if we look at their overall price predictions and price targets among experts and professionals, we can see this company could be worth anywhere between $800 and $1,650. And I would say right now is a pretty good time to buy this company. Their market cap is very comparable to Snowflake, coming in at $44 billion. And I would say that this is actually a better value opportunity than Snowflake, and I'll tell you why in a minute, but it's essentially because their accounting ratios are much more impressive. Mercado Libre is often called the Amazon of Latin America, and although there's a huge difference between Mercado Libre and Amazon, they both specialize in e-commerce. Now, what differentiates them is that Amazon also has their own cloud computing service called AWS, and Mercado Libre actually operates in the fintech space by providing digital wallet services. But overall, these companies are very similar to one another, and they have similar business models. Mercado Libre has actually helped popularize online shopping over in Latin America, and it operates one of the most visited online marketplaces in that particular region. So essentially, yes, they are like Amazon. Imagine Amazon, but just for Latin America. Now, what I personally like about this company is that their services and products are synergistic. What do I mean by that? Essentially, when a customer comes into their ecosystem, even if they're a merchant or a customer, they're going to look at their online shopping platform where they can make payments and or pay using Mercado's digital wallets. So clearly their two products and services work together synergistically, which is very impressive. That gives consumers a more compelling reason to use both products simultaneously, and Mercado Libre can literally make double the amount of revenue from this because they're using both of their own products. On top of that, Mercado Libre reported extremely strong financial results, and they are very consistent and resilient on this basis. For instance, their financial metrics have been outstanding, and I also want to say that their revenue grew at an annualized rate, which means a CAGR of 68% since the third quarter of 2019 until right now, and that is crazy amazing. I love that. I also want to add that their free cash flow per share increased at an annualized rate during the same duration by 76%. So this company is absolutely primed for not only future growth, but right now, the company is doing very, very well. Investors have a great reason to invest into this company, and they also should anticipate that this momentum will keep on giving. Meanwhile, Mercado Libre targets some of the three largest markets, which are Argentina, Brazil, and Mexico over in Latin America. America. So as these three countries, which all rank in the top 10 fastest growing countries in the world in terms of e-commerce sales, this creates a huge tailwind, which is very good news for Mercado Libre, which specializes in that exact area, which would be e-commerce. So overall, Mercado Libre is very well positioned to create shareholder value. But here's where we get into the great part, and that's the fundamentals and their accounting ratios. We have to keep in mind that their current share price is only trading at 4.7 times their sales. Their PS ratio is just 4.7, which is unheard of regarding a growth company of Mercado Libre's caliber. That is absolutely awesome, and that's why I personally am buying this company. So this company is a fantastic bargain to buy right now. So right now, why not snag up some shares, or at minimum add this to a watch list? But overall, I would say these three companies are primed for future growth, and you could be set by investing into one or all three of these companies. However, remember not to over allocate yourself to any one of these companies. Practice proper risk management, and I wish you the best of luck. With that being said, go and smash that like button for more videos like this one. Subscribe if you are new, comment your thoughts down below, and I will see you in the next YT video.